Hi, my name is Barbara Friedberg, and I am here with good friend and twice published author, Jonathan DeYoe.
Hey, Barb, how are you?
I am wonderful and even better since you're here.
Oh,
We're going to talk about his new book, Mindful Investing, and I think it's going to blow your mind in a good way. So, let me tell you a little bit about Jonathan because he's taken a rather circuitous path to the investing world. I think he may be, in fact, one of a kind. His education spans a bachelor's degree in philosophy and religion, a graduate degree in religion and Buddhism, followed by, wait for it, study in finance at the CFA Institute and the University of Chicago Business School. His work spans financial advising. So you're not taking investment advice and guidance from only a Buddhist student, but also someone who is qualified to talk to you about investing and finance. He's worked at financial advisory firms across 4 different companies and has had his own company for many, many years. And finally, he does run a side gig as the owner and manager of Mindful Money, his proprietary investing website. So, did I cover it, Jonathan?
you got it's a nutshell. You got it from beginning to end.
Okay. Thank you, LinkedIn. So, what is mindfulness?
Uh, I mean, I don't change the definition of mindfulness for investing. Mindfulness is the non-judgmental awareness of the present moment as it's presented or experienced by our senses and our thought space, so our feelings and our thoughts.
It's very popular today, isn't it?
Yeah, it is. I mean, I for good reason. I mean, it's a very useful skill. It's a very useful practice. Meditation actually helps every element of your life. I happen to be the guy that's applying it to investing, but there's people applying it to everything else in your world.
So, how did you go from studying religion and Buddhism to becoming a financial advisor? That seems like kind of a relative disconnect.
Yeah, for sure. It's not when you look at when you zoom out and look at the whole story, it's not quite as much of a disconnect. Often the things that you want when you're young are the things you can't have. And I was raised pretty poor, and so I wanted money. And so when I was like 8 or 9 years old, I was visiting in Rapid City, South Dakota, where I grew up. There was a private ledger office. Private ledger, fast forward 15 years, 20 years from then, becomes part of Linsco Private Ledger. They're the largest independent broker dealer, I think, on the planet, at least in the United States. They're huge. 20 something thousand advisors. And so I went in and talked to a broker when I was 8, 9 years old. And he said, yeah, here's the value line research, knock yourself out, read all you want. So I was reading value line research as a 9-year-old, which pretty much makes me the biggest nerd around. And then I went to school for finance, but I got really bored with finance because I was reading it and studying it, when I was young. How do you start a business? My dad was, interested in real estate. So he gave me all those real estate books. I did a lot of this stuff when I was a kid. And so went to college, studied finance, got bored, loved philosophy, loved comparative religion, loved writing, loved deep thinking. My professor said, hey, you should switch to this. I did. I had lots more fun. One of my professors said, hey, how about grad school? How about you keep studying it? So I came out to the Graduate Theological Union in Berkeley, moved from the middle of the country to the West Coast, and met brilliant people. I got to meet great professors in the Buddhist studies world. But in Berkeley, you also meet people like Robert Reich. You meet people that are just very, very brilliant economists in Berkeley. And I was at the 24-hour fitness, and right next to me on the treadmill was Robert Reich. So that's, you get to chat with people that you normally wouldn't have access to. And I didn't actually graduate. I didn't get my graduate degree in Buddhist studies, so I dropped out. My first wife said it's time for me to support her in grad school, so I did, and I went and got a job at Dean Witter. And in the first 5 years of my career, I was at 7 different firms, actually. 4 decisions I made, and then 3 were mergers. And then finally, as you said, I started my own company in 2001.
That's fascinating, and including the part about Robert Reich. So clearly, you've got a unique perspective.
For sure.
And your first book, Mindful Money, kind of opened the door to that. Your second book delves in a little more specifics into investing and how you can kind of combine the two seemingly, although not in reality, disparate areas of mindfulness and investing. So, what does mindfulness have to do with investing?
So, where is mindfulness beneficial in life? Mindfulness is beneficial in life anywhere there's stress or emotional response to something immediate. Now, humans are basically, bred is the wrong word, but we have over, thousands of, tens of thousands of years, we've developed our brain structure. And our brain structure, as Kahneman and Tversky talk about it, as most of the behavioral psychologists and behavioral financial people talk about it, our brain is split into multiple different chunks. As you move from the base of your brain, which is your amygdala in this area here, towards your frontal cortex, you get more complexity. But most of our decisions and most of our reactions occur here in our amygdalas. And what mindfulness does, specifically when you have a fight with your spouse, or you want to blow up at your kid, or market takes a 50% correction. What mindfulness does is it gives you a chance to say, okay, I'm not going to react with my amygdala. I'm going to push that up to my frontal cortex, and I'm going to think about, how should I speak to my spouse right now? What will be the most, should I just lash out and attack again? How should I speak to my 18-year-old who's doing something really stupid right now? Should I lash out and tell them they're wrong and disempower them? Or is there a better way to do it? And then how do I react if people are bringing me this exciting new investment idea, or markets have just collapsed 35% in a matter of 30 days, like they did in the pandemic? What do I do about that? And if I think about it, I might not do the same thing as if I didn't think about it. And so mindfulness just slows down the video enough so you make better decisions. You have to pair it a little bit with some wisdom, with some learning, which is why, your work and your writing and your blog and your podcast and everything you're doing is so important, because you're trying to educate people about making the right decisions. And I'm trying to do the same thing. I'm also trying to give them that space so that, I'm aware of my uncomfortableness with the market decline. Now I have to make a better decision. I'm realizing now is a point of risk. I might make the wrong choice. How do I make a better choice?
That might have been the best definition I've ever heard in my entire life.
That's what I'm here for.
That was so practical.
Yeah.
That was so practical. It's almost like you can use mindfulness to keep you from being stupid and making the worst decisions by just allowing yourself to take a step back.
Yeah.
And to just
all of mindfulness is about, the mindfulness practice, when you sit on your cushion and you stare at your wall, all you're doing is you're noticing when you're distracted. And this is beginner's mind. There's all kinds of levels of mindfulness, right? But the beginning mindfulness is just noticing when you're distracted and then returning to whatever your anchor point is. In finance, and I think you agree with this, you have to have a plan. If you don't have a plan, you don't know where you're going. You got to write something down. You got to put something on paper. That is dollar specific and time specific. I want to retire at 65. This is the pool of assets I need to make that happen. Or I have a kid that's going to college in 7 years, and this is the pool of assets I need to have that happen. Or whatever, I got to buy a second home, so this is the pool of assets I need to have that happen, and when. So you have to have time specific, dollar specific goals, and then you've got to be able to stick to the plan. So like your breath is your anchor when you're meditating, your plan can be your anchor when you are thinking about personal finance. And without a plan, you're just floating on the wind. Whatever thought or social media post tracks you today will be the thing that you pursue tomorrow.
What do you think is the biggest mistake that investors make?
This goes, I've been talking about this for 20 years, but about 20 years ago, I would stand up on a stage and I would hold up, I didn't have as much money then as I have now. I'd hold up a $10 bill. I wouldn't hold up 100. Now, if I did, I'd hold up 100 because it's cooler. But I'd hold up a $10 bill and I'd ask people what this is. What is this $10 bill? And they would say, it's money. It's money. It's money. And I would say, no, it's currency. And the biggest mistake people make is confusing the two things. Because once we confuse those two things, it leads us down the path of our investment choices, often to our detriment. If you think the $10 bill is money, and your goal is to protect your money, then you'll try to protect those 10 currency units. The problem with that is, and you know this, in 10 years from now, those 10 currency units will only buy 6 currency units worth of stuff. And then 10 years after that, it'll be 4. And 10 years after that, it'll be 2. So the value of the currency units decline because they're not money. The thing we want to protect is money. That's our purchasing power. And cash and fixed income and the things that we look at as safe, or that the pundits talk about as safe, or that our parents told us was safe, or that the people in the water cooler, I've got some equities, but I have these bonds and they're safe. It's safe in terms of there's going to be very little change in currency unit value. But there's going to be a lot of change, and they will not keep up with the inflated currency values. That's the problem. So if you have the wrong idea about what that 10 currency units is it money or is it currency? You end up favoring things like fixed income. That's a huge problem because your returns are going to come from equities.
Another great answer.
That's what I'm here for.
So, given this, given you obviously have quite a bit of expertise in investment, in advising, and I know because I've read the book and you and I have chatted about this as well. Tell our listeners, what is the most sensible way to invest in order to meet your goals, which we've already discussed?
Well, so I mean, you always have to hedge and disclaimer and all this kind of stuff when you talk about this on a public venue. I mean, it is very personal. It is very personal, because your ability to sit, and we've talked about this exactly, this exact topic, because I am 100%. I have my emergency fund, and then after that, I'm 100% in equities, and I believe that that's probably the best way to go. But I can sit through a 50% decline without blinking. Like, I cannot worry about that, partially because I have enough, partially because I understand how history works and I know it recovers and it doesn't stress me out. It doesn't create the same kind of amygdala, lizard brain response in me as it might create in somebody else. So you've got to know yourself. But when you think about it, when you look at the long-term returns on markets, you can say that small companies, create 10 or 11% returns. Big companies create 9 or 10% returns. Bonds create 5 or 6% returns, and inflation runs at roughly 3%. So it looks like, when you say that 10 versus 5 or 6, it looks like stocks are twice bonds. But when you take out inflation, stocks are 3 times bonds. And that difference is enormous. If you've got goals that are 10 years in the future and 15 years in the future and 20 years in the future, you've got to have more of the 10s and 11s, which means you have to have fewer of the 5s and 6s. That's how you get there. That's how you build wealth for your family. That's how you build wealth for your future. The reason we invest is for our own retirements and for our children and for our communities. How you get more that you can support those people and yourself with is you have a little bit more, push the envelope with the equities, broadly diversify. Don't ever get enamored of any individual thing. Don't get enamored of one country. Don't get enamored of value versus growth. Just own it all. Own it all. Don't think about it. Don't overthink it. Just broadly diversified global equities. That will be the core of any portfolio I would ever recommend.
How do I do that? Do I just go out and buy Amazon, Apple,
No, no, no,
Alphabet,
no, 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 no,
Google,
no. No, no, no. I mean,
Netflix?
you could do that. There's like 15, 16, 18,000 publicly traded companies in the world. You could go out and buy, figure out, okay, the biggest one's Apple, so I need most of my money to go to Apple. And then there's these other little ones that you probably never heard of, probably in, sub-Saharan Africa, that publicly traded on the African exchange, on an African exchange, I should say. And you could buy a share in each of those things. But why would you do that? Like, you could just buy the Vanguard all world, portfolio, or the dimensional, global equity portfolio, or iShares all country world index, or there's probably 7 or 8 different tools. I actually list them in the book. There's 7 or 8 different tools that are all the equities on the planet. There's different flavors. One will have, because dimensional will be tilting towards value and small. Vanguard will be a more pure, global cap weighted. And don't overthink this. It doesn't matter. Like, they're all going to end up in roughly the same place in a decade anyways. So don't stress it too much. And then whenever you have money, you add to it. When you need money, you take some out.
Now, this sounds like super easy. Why would I ever need an advisor like you?
So great question. 15 years ago, an advisor's circle of competence was different than it is today. I would argue that even 15 years ago, when advisors had access to more information than people in the everyday public had, they still didn't provide a lot of value in terms of stock selection or investment selection or market timing. It is what people expected them to do 15 years ago. And to some extent, people still expect them to do that. I don't think that's really part of the advisor's circle of competence. I am an advisor. I've been an advisor for 25 years. I have tried investing in every way you can imagine. I have tried, all kinds of options and collars, and I've tried individual equity. I've tried everything you can think of. And maybe I'm stupid. Like, maybe I am not smart enough to do it. And I think that there will be people that listen that go, no, I can do it. Like, you, Jonathan, you don't know what you're doing, but I'm smart enough. I can do it. Good for you. Like, give that a shot. I don't believe anyone is smart enough to beat the market consistently enough or regularly enough to actually add value over time. And the process of trying to do it will take you hours and days and weeks and months and years of time. So if we can suggest to you that you could buy the ETF or the global fund that weights it all in an intelligent way, buys it all in one thing, and you could save all that time, you could earn more, you could have a better relationship with your spouse, You could, of the money that you're earning more of, you could funnel that more to the investments. By the way, your savings rate is way more important than your return rate. The rate of savings is way more important to your outcomes than your return rate. So advisor's circle of competence, this is all to say, advisor's circle of competence isn't market performance. It is not. No one can add any value there. So what do advisors do? I think that's okay. So why would I hire an advisor? There's sort of three different areas I think are important. First, knowing the lay of the land, knowing the groundwork, understanding the questions to ask, just beginning to know what's important. I have gone through a lifetime of planning with hundreds of clients. I kind of know how it unfolds. I kind of know where they're going to react. And I can talk to somebody the first time I sit down with them and say, this is what's going to happen in the next 15, 20 years of your life. These are the things that naturally occur. These are the things that people go through. This is what you can expect that's going to feel like. So it's laying that groundwork. And then the second piece is actually doing the planning, making it time specific, dollar specific, making it all work together so that the cash flows work, so they can support it, so all your goals can come into place. And when they can't, because you want more than you can have, helping you make the right choices to get the right things done in the right timeline. And that's the second thing. The third thing is, and this is what Vanguard, Morningstar, Russell, all the academics that research this is the real value an advisor provides. And it's called behavioral coaching. It is, and I'll sum it up this way. It is the phrase, don't do that. Hey, Jonathan, I'm thinking about buying this $3 million house. It's really nice. It's perfect. It's everything I've ever wanted. And I will say to that person, without all the details of the plan here in front of us, don't do that. That is going to cost you way more than you have in income. It's not going to be what you think it's going to be. Don't do that. Hey, Jonathan, I'm thinking about a boat. Don't do that. I'm thinking about a vineyard. Don't do that. I'm thinking about markets are, this is March of 2020. Markets are in horrible decline. People are calling me left and right. I want to sell and go to cash, John. I'm just going to say, don't do that. This thing recovers. Don't do that. The challenge, I can say that all day and I can know that I'm right. But if a client can't hear me because I'm not speaking in a way that they can hear, that's not on them. That's on me. Right. So a good advisor learns how to coach a client in a way that client needs to be coached to keep them on the path. I've had hundreds of clients and they often try to jump off the path a couple times, dozens of times per year. It's a purchase. It's a fear of investing. It's whatever it is. And so once we know what's important, what we should be planning for, and then we plan for it, and then we just help people stay on the plan. And that's really the function of the advisor. There's nitty-gritty details that we can go into, but those are the three things. What's important, plan for what's important, stay on plan.
But Jonathan, what about Bitcoin?
Yeah,
What
no.
about alternatives? What about private equity, options, trading, all those glittery things that are calling me to make big, big, big money, much better than the stock market? What should I do about those?
So there's two sort of specific categories that you brought out there that I think are really, and there's lots of categories, but 95% of people that engage in trading, whether it's Bitcoin trading or options trading or low small price stock trading, whatever it is, 95% of people that engage in it lose. And I'm not making this up. The vast majority of people that try to do it lose doing it and would be much better off owning the S&P 500 or the All Country Global Index. So put that to bed. The two categories I think are interesting are the crypto world and the private equity world. I had a guy from Goldman, the grandfather of private equity, tell me, this is 15 years ago, Jonathan, the only place that private equity provides any real value is in angel. It's in investing in companies that have no track record. We have no idea what's going to happen and no value. All the other stuff, leverage buyout, hedge, private equity, mezzanine deals, all that other stuff is to benefit the house. The fees are so large. They do not keep up with just the regular index that you can buy for no cost, literally at Fidelity, or for very, very low cost through iShares or Vanguard. So those iShares and Vanguard is far better, much better choice. But I'd add this other layer on it, specifically around things like Bitcoin. Because you got to remember, in the late 90s, early 2000s, there was this whole tech wave, and this was all, the internet was a new thing then. And had you invested in all of those companies in 2000, you'd have lost 80-90% of your wealth. And people that invested in Bitcoin, they know this, right? They've lost 80-90% of their wealth 6 times since Bitcoin came out. It's still at an all-time high. But it zigs and zags so viciously that if you started earlier, you're probably not in it anymore. The way I invest in crypto is I own equities. If crypto proves to be valuable, if it works out, companies are going to use it. If it doesn't prove out, companies won't use it. Some companies will try. They will be part of losing when crypto loses. companies will try, and if it's successful, they'll make a bunch of money because of it. It'll reduce expenses. They'll use it to they'll use the database features to manage their own databases, to track ownership of things. There's all kinds of value in the blockchain and all kind. But companies that use the technology will give me the benefit of the technology because they're going to create savings and create products based on that. So I like investing in all the companies, staying diversified. I'll get the benefit of crypto by doing that.
And if I can add one more thing to that, if you can't help yourself, and if you have to go after that shiny new object and you want to day trade and you want to go for Bitcoin, make sure that you're only doing it with money that you can afford to lose 100% of. So just take a small percentage, 5% of your overall investment wealth. And look, maybe you'll be the 5% out of 100 that strikes it rich. I doubt it, but
it could be. I mean,
it could happen.
I write in the book about, you maybe already get the sense of this. I love business. Like, I think business is amazing. I think they do great stuff in the world. I think it's really, really important. And I'm enamored of small business. I think entrepreneurs that create something out of nothing, they blow my mind. It's amazing to invest in these guys and gals. But in the book, I talk about, I use about 10% of my wealth and I invest directly in tiny startup angel investment kind of companies. And I'll tell you this, honestly, I've been doing that for 15 years. I've never made a penny at it. I've invested in dozens of private companies. I've never made money at it, ever. I have a couple that have done well relative to the others, but none of them have kept up with just the index that I own, right? So that's always been better for me.
And before we wrap it up, our listeners, of course, need to get Mindful Investing. We'll have a link below for all of you. We don't want to talk about everything in the book and spoil it. And finally, Jonathan, what's up next for you?
Well, I'm starting on the third book in the Mindful Money Investing series. I'm in the middle of writing or starting to write Mindful Retirement. That'll be the next book. You're the first person to ask that question, so now it's out there, and I pretty much have to follow through and do it. But I'm also, I'm retooling the membership program at Mindful Money, and I'm retooling the boot camp so that I can sync them together to give more people more value at a lower price. So everyone should subscribe to the newsletter. That's probably the best place to hear about those things when they're coming up.
Well, we will put a link to that at the bottom as well. And I want to thank you so much for coming on. I feel like the listeners got so much value out of this interview. I know I was impressed.
Oh,
so
thanks,
we will put links below to the book, to the Mindful Money platform, where you can sign up for all the different things that Jonathan offers through that. And we will see you next time. Thank you so much, Jonathan.
Thanks, Barbara.